Hi, this is Rob Sechrist with Pelorus Equity Group, and we would like to share with you the story of how we went from 0 assets under management to 75 million assets under management, most of that being within this past year during COVID. You know, just in 2 months, we've gone from 56 million to 75, almost 75 million. So we're raising capital insanely fast now.
Wow.
But it all, so the pieces were there. We had the experience. We had the ideas, we knew we had the deals. What was the hard part was getting the investors educated and comfortable. But at the time, it doesn't feel like this. This is like the synthesis at the end of kind of the debrief. But at the time, it feels clunky. It's frustrating. It's dollars going out the door. It's uncertainty. But you just have to have faith in yourself and in you have to have a commitment in yourself and a passion for what you're doing. And if you believe in it and you know that you've thought everything through, and if you're experienced in the industry and you've thought through all those choke points, you're going to get there. It's just going to take time to get people educated and to figure out the right way to educate them too. We thought we wouldn't have any trouble raising the full 100 million for our fund within the first, year at the most. And that was not the case. So it was not easy. It was a slugfest. So we've been doing it for 4 years. It took 4 years to raise 144 million. The first year, we only did like a couple. The first year we only did a couple million. The next year, a few million. And then we launched the fund in 2018. We only had like 1.2 million or a couple million assets under management at 1 year. And then just last year, we only had 6.5. So we went from 6.5 at the end of last year to 56 million at the end of the last year of assets under management. And average 50,000 or 500,000 a person.
Average check size is around 50.
It's about 175, I think. I think last time I checked 172, but it's actually a lot of 50,000s and a few 500,000s and a few, our largest single check is 3 million from one person. Our largest fund is probably 4 or 5 million. And then we have groups that aggregate money to us in their channels. And some of those are 25 million and 5 million and 10 million. So different, and all of those things take time. Those capital aggregators is a category that we call some people. Some are forums. Some are just groups that we've kind of organized for somebody on their own. We gave them the template. We said, look, why don't you just go to your people and see if this works for them? Just like I told you about the cannabis equity fund. So those are all little strategies that we try to employ. And, every once in a while, one just takes off. We're just about to put one together next month with 12 of the firemen pension funds in Florida.
Oh, wow.
Yeah. And so that process was such a slug and trying to figure it out. Trying to take the easy way, hiring a broker dealer, going on platforms, and none of it worked. None of it. And either we were too early, the investors didn't understand it, or they loved what we're doing, but they just couldn't invest in what we were doing. And so it was an evolution of literally spending money, going to conferences and figuring out what works. And so you guys attended the Benzinga conference, which we had kind of figured it out by then, but we'd spent like $250,000 up to that point. IMN conference, Lido conference, all these other conferences, which were really, really good because we got to know the industry and the people and the thought leaders and really get our finger on the pulse. But we also realized that we were like the odd duck because all of these conferences were purely focused on brands and the ownership of brands. And we were like an ancillary product to all those companies. And yet we had better returns than a lot of them did. And we were secured and cash flowing and we were helping them all. And so what we kind of learned is, one, know your investors' appetite. So we were able to find conferences that had really high investor attendance. ArcView had probably the highest ratio of investors to attendees I've ever seen. And we were going to be a sponsor for that. And it was a really great conference, really good content, really good panelists. But what we learned, and this was something we learned too, as much as we really like the conference, we never go to the first one and spend any money. We just attend it, because what we need is investor intelligence. We need to know what's going on there before we make a commitment there. And so what the investors there wanted to be a part of a brand. Being part of a fund that had senior secured notes at kicking off 15% yield, that didn't move the needle for them. You know, they're only investing $50,000 to $250,000. They wanted to be a part of something at the beginning and watch the brand and say they're an owner. And so we learned that in that scenario, and that was kind of our learning lesson, is that know your target investor, what they're actually looking for. Try to get intelligence on that. And usually you can't get that unless you are willing to mingle with enough people in the crowd and just kind of let that come out as you talk to a lot of people. And when I go to conferences, I am talking to everybody the whole time. I don't judge anybody. I try not to judge anybody, which is hard, but I try to approach everybody or be approachable. And I start for first thing in the morning at 7. I go down there, I be at the breakfast area, and I just mingle with people, because that's where you're getting that intelligence and seeing those conversations and hearing those conversations and standing at the tables and seeing what everybody's about. And, a lot of them are ancillary people or looking for stuff, but the few investors, when you get in and find an investor, which a lot of times they don't want to say they're investor too, but once you do, you kind of learn what their appetite was. And so ultimately over time, what we learned is that real estate investors, who you would think would be the natural fit, of our 250, we only got 25 to come over. The real estate investors were not the best fit for us, which is doesn't make sense, but ultimately it did, because there was too many hurdles before we ever had a chance to pitch the investment. And so what we ultimately recognized is, and we changed this in our questioning of our automatic marketing and all the things that we sent out, our form fills and stuff. Are you a current cannabis equity investor? If you've invested in cannabis, you've already done a couple of things. One, we know that you are familiar with the space. 2, you figured out how to get your money invested there. Most of them are individuals, but if it's coming from a family office or from a fund, there's hurdles that you have to get through there. Errors and admissions insurance, your fund offering documents, your attorneys, your banking, all kinds of stuff. And so we learned, if we just ask this one question, have you invested in cannabis equities before? If the answer is yes, if I've got 1,000 investors that have interest and 2 of them said cannabis equity investment, I'm going to contact those, and I'll probably get one of those guys, if not both of them, to invest with us. And so the pitch to them is simply just a diversification of their cannabis portfolio. Do you want to be 100% weighted in all equity? In this, you've already decided this is an asset class you want to be in, but you probably weren't even aware there was debt opportunities. So that's the pitch there. The downside is that depending on what the cycle is of the opportunity, the equity may be so great that they don't want to burn up their gunpowder with us. You know what I'm saying? That tying up $1 million when they could put $1 million into equity, that's a better play. But it kind of goes back and forth. For a while, when the stock market's tanking for the cannabis equities, everybody wants to be with us. When the cannabis market starts taking off again, it's a little bit harder. Then there was something else that happened because of COVID. In COVID, we didn't think that, March came around. We were afraid to even call somebody, because we want to be respectful of optics. Hey, this is Rob and Tanya from Pelorus. We want you to invest. We're like, yeah, we're trying to figure out if we're going to feed our family next week, or so people had to get their personal lives in place. They had to get their work life in place. And then they had to figure out most people went to maximum liquidity as well. And so what we decided to do was let's take advantage of that maximum liquidity event, because eventually people are sitting on money and they got to get it back out to work. So what we did is we focused on reducing our minimum to an amount that would allow them to put their foot in the water on a secured investment. And it was a safe place to put that capital back out. So we were the first people to probably call them with a compelling story of an asset class that was truly unaffected by the pandemic. And we were deemed an essential business for all of our assets. And we simply went with this approach. Are you too heavily weighted in non-cannabis? Doesn't it make sense to diversify into a specialty asset class that, one, is less effective in a real estate down market or a real estate down cycle, and even proven with the most recent pandemic where we were completely unaffected? We were the one asset class that it didn't infect us at all. And that even the real estate guys started moving pretty heavily to us. And then when they started finding out more about the actual investment, they started telling their friends, and that all came from the structure of the fund and how we operate. And what we've learned is the principles that we originally set out the fund with: be the first no-cost fund out there. Have a unique, regardless of what the investment asset class was, the structure of the fund was unique too. And a lot of people are like, why are you doing this? You don't need to do this. Well, it was part of our thesis of being a unique fund on its own. Our auditor at the time, Armanino, does hundreds and hundreds of hard money funds across the country. And we're like, we want to be special in the structure too. He's like, can we go, the trend is no cost investments. Can we get there? And they're like, well, you can't get there per se, but you can in the long run. And what he meant by that is that you got to charge an asset management fee, because at some point you're going to wind down and you have to cover your expenses when you wind down. But if you structure it with alignment from the manager, where you're sharing more revenue from the manager than the asset management fee, then it gets to no cost. And so we went with that structure. And that confused a lot of people. Today, if we were to launch the fund, we might do a slightly different structure, because it almost takes more to explain to people how we're able to sustain the fund and operate the businesses when they think we're not making any money and that we're not motivated. And we have to explain to them that part. But once they get all this, there's so many parts for them to understand. It's all too good to be true. We lose them, and then the yield is too high. So if we were to do it again, we'd probably have a small carried interest split of 5 or 10% and a prof of 8, a 1.5% management fee, and nobody would think twice about it. We'd also reduce our return to probably like 12. And even though we'd outperform it no matter what, it's just everybody assumes that we've got a risky investment. But anyway, if we can get through that education process with everybody. So what we ultimately learned is find equity investors, or the other strategy was take them to a facility. Don't ask them, just say, hey, come let me educate you. I've never taken somebody to one of our facilities and had them not be completely amazed with the caliber, quality of the assets, the operators, and what we're doing. And so that sells it in itself. I've never sold our investment. I've only educated. Here's the structure of our fund. Here's our performance. Here's how we do things. This is how we got there. And that I let them make their decision on their own. But that's why we took you guys out to Desert Hot Springs, was so you could film that stuff. So we couldn't get people out there. It's a whole day event, and we can only get so many people in at a time. But once we created those videos, especially the brand video that you did, that was a game changer for us. We hadn't had a professional company, and this was something that we really truly attribute to your company, is your team had I don't know what the right word, the way that we interacted with you and your team was the most important part to us, because that we could feel that you could understand our story, and the synergy between us was really good. We'd had lots and lots of people offer to it, but the synergy wasn't there, or it wasn't as good. And once we felt that synergy was there, for example, that engagement of how you did that and the questions and how you could just pick it up and capture in the moment, I'm like, these guys are on it. And so us realizing that, I was able to articulate that to my team. You share the video without saying, hey, you need to sign an NDA or this and that. You just did it all in good faith. That would allow me to share that with my team, and I got them all on board, and we were able to make a commitment to you for a series of videos and an education series, and have you guys come out with us to Benzinga, which was, that conference was by far the best conference. And that conference, they give you the investors, their names, their emails, and they have a whole series of questions. Have they invested in cannabis equity before? How much? What did they do last year? How much are they doing this year? There was $500 million in commitments at that show that we were at, of investor commitments to come in and invest that year. So all of these things we kind of had to learn. And I don't think it would directly apply to each one because it's a unique asset class. It's a unique investor. It's a, we've got all these issues. But ultimately, once we got traction, and ultimately we were trying to get the family offices and the institutional size check writers, and we'd been to the hedge funds, and we got to meet them all in New York, and all of them love what we did, but they're like, I don't know if you guys, if this is going to work, and you guys are just starting out. And ultimately, it wasn't those guys, it was the little guys, it was the retail guys, it was the guys like you, and the guys like myself and all of our friends, and the 50,000, the 75,000, and now 450 of those guys makes it 75 million assets under management. We could bring in any family office all the way up to 35 million right now and board it in one slug and not even break our REIT, because we have such a huge diverse base, and that guy would not have control of the fund. We would have majority control still. So that, and what I mean in voting rights, that we still control the fund, but there's nobody that can wag the tail, even if they're a big investor. Even if one of the biggest hedge funds who we're talking to right now wanted to write a check for 25 million bucks, they're not the, they might be the largest capital in one chunk, but they don't have a voting majority if we had to put out a vote for something. So all these things we learned over time, and Dan and I have realized, and tell our sons and our peers and the people we work with, that it's never the easy way. It's going to be hard. You're going to appreciate it more. It never comes when you want, and it takes time. No matter how bad you want it, time is something that you can't get around. It's a factor of the event. Even if you have something ready to go, it still takes time for that to happen. So some investors we've been working on for 2 years that are just now coming in today from Benzinga. We just sent out that update on our distribution. They're just now finally reacting. They've seen us enough times. They've heard enough about us. They've seen enough press releases, so it's a multi-pronged attack. But I would say that what you can't afford to have happen is, once you have somebody interested, you can't lose that. That it took so much money and effort and everything to get that person interested, that you've got an automated system, but somebody's got to pick up the phone and call them right when that comes in. And so that you've got somebody that's reaching out to you now. Capture that while it's right there. So we have a team that calls out, and our investor relations gets a hold of them and calls right away and starts that process. And we have formatted emails of everything that they need instantly. And in those formatted emails, we have the 15 YouTube episodes that you guys made for us. We've got a webinar pre-recorded. We've got our performance, and it's easily digestible in different formats of what's easy for them. At what level do they want to go to? Most people just look at our returns and like, okay, I'm interested, because it shows, 3 years of returns, the double-digit returns, the last 3 months in the 24-25%. They're like, holy crap, this is a compelling. I at least want to know more. And they can go and watch the short YouTube videos and see the tours, or they can listen to a half-an-hour webinar, so they can pick which direction they want to go. And then we're monitoring all that. When they click on that, when they go there, we know that they did that. That's all being scored and aggregated into our system. And Tanya will be calling and following back up on them softly with an email, or calling them and just gently moving things along to show them that we're actually being proactive, but not not irritating in any way. We'll usually to reach back out to them twice. So those are all the things that we've learned. There's all kinds of side things that were important on what we learned. Everybody tries to use these portals to do your docs and accreditation, and it's just more places for it to fail. How bummed would you be if you finally got an investor, he gets to the portal and he's like, I'm not going to put my social security in this platform. I'll just do this later. And you just lost that guy. It's like every place that there's a potential break in the system, you want to eliminate those. And the way to eliminate those is have somebody call them and speak to them, because then you can aggregate that you can get in a sense for what they want. We usually will put everything together for them and send it to them by DocuSign. And so it's so seamless that the number one comment from all of our investors is we've never had a fund that was more investor friendly and easier to get onboarded than you guys. So it's all of those things of learning that. But now we've got the size and scale that we're working on getting on Schwab and Fidelity. And, we were asked to go public, which we turned down. So we've got all these opportunities, but we've got such a successful base of what we're doing. We don't need to go those ways. We're good. We're good to just keep plowing along like this. We'll get to $250 million probably in this year. So that's kind of all around about the different things that we've learned. But it was all trial. It sounds easy. It wasn't. I mean, my partner's like, dude, you just need to focus on money. We have so many deals. Just bring in the money. And I'm like, we're working on it. Now we're able to keep pace with that.
Can you disclose how much money you've raised across how many people?
Yeah, it's 144 million.
Okay, across how many?
Yeah, so the fund is currently 75 million over 400. It's probably 480 LPs, I'm guessing. Mm-hmm. Somewhere in there. It was 450 last I count. We get 2 or 3 investors every single day. But those things sound easy to say, but it's much more difficult to do. Know your investors. Well, how am I supposed to know my investor if I can't even find my investor? Like, how do I know that? Well, that's where you've got to get more granular. You got to get out on the ground. Well, the only way you could possibly know your investors is go to conferences that you think our investors are attending and get an idea of those. And that's hard to figure out that too. So IMN is not a conference that has investors. It's all industry guys. And it's all somebody that wants something for somebody. There's no money changing hands there. It's relationships and how they're going to use each other, which is good, which is all part of conferences, but there's no investors there per se. I mean, not to the extent that you're looking for. So I think that people should try to chip away at the small and the slow, because it's better to make mistakes on small things than on big things, because you only get a first time to make a first impression once. And if it's a small one, you mess it up, whatever. And it's part of the process. You can't get to where we got to without messing up. You've got to mess up to have part of the process to learn. It's just how you utilize that information of when it's not working or it didn't work or what you did wrong. And sometimes it's hard to know that until you're a year past it, but you're trying to evolve that stuff. So for us, we had to make the investment. So we had to break the company into 2 pieces. You can't run a company and be out working investors 24/7. You can't be sitting there ready needing to wire while I'm sitting there on a panel live, So we had to delineate the company. And so my side of the company we mainly manage and run the fund, the marketing efforts and the investor relations and all the capital raising, strategic relationships. The origination team underwrites and just focuses on deals, which is a big, they've got a lot more work than we do, but ours is probably, everybody likes what they do. But so by doing that, it gave us the opportunity, and we had to have the cash flow. We had to make the investment in ourselves to be able to have that opportunity to go out to Benzinga and to do these things and to spend that time and money to learn these things and to start implementing them over time, even though we didn't know what it was at the time. It's data. So you're collecting data, which conferences work, What kind of investors are there? Are these investors people that are able to make a decision for themselves? Is there somebody else behind them? Is it a family office and this is the analyst? If it's a family office and you don't have $100 million and been in the business for 3 years, don't even waste your time. You're not ready for those guys. And if you come back to them in 3 years, they're going to remember that you were this, and you're focus on the little guys, just the 25, 50,000, get your processes in place, get your systems in place, get the scalability in place, get everything rolling, get input and feedback, talk to your investors so you know what they like and what they don't like. Ask your investors, they're a great resource. What conferences do you go to? How did you hear about us? We always ask, how did you hear about us? That's number one thing that we want to know. What conferences, what do you listen to? Do you listen to any podcasts? Are you on an email distribution list? That you want to know, ask your investors. That one guy you've got a golden thread that you can pull to see where he's pulling his information from. Once you get to the next one, pull on those and see where they're getting their information from. And eventually you'll get an aggregate of information. You have to think about all those elements and how you can grow and scale the company to achieve those goals that you want to do. If you're going to just go out and raise a fund and that's your only vehicle to have any revenue, you better have raised a lot of money to get by in the interim. And I don't think that's a good way to run a company either, because if you have money, you tend to spend it more easily than if you don't have the money or you're doing it out of cash flow. So I always tell people, like when people say, hey, how can I get ahead? How did you get to where you are? And I said, I remember this just recently. I was going through the guard gate in my M5 and the guy's like, nice car, what do you do? I'm like, I said, I do finance. He's like, well, what's the one advice that you could give a guy? And I said, once you get 6 months of reserves, that's the number one thing you can do for yourself. If you cannot have the cushion of money to allow you to change jobs and to have that freedom of being able to switch and pivot to different things or lose your job without being destitute, you can't even think about investing. So that's the number one thing, is to have that, because taking $1,000 or $2,000 and investing in something is not going to move the needle on changing your life. But not having any money, that $2,000 could have made the difference for buying food for your family for a few weeks or whatever. So I tell people that it's gonna work on what is working, work on your side hustle, work on your business plan, use somebody else's time to pay your salary or your day job, and at nighttime be working on all this stuff, because you can do all this stuff on your own. And you don't want to quit and go full time until you've got enough cash flow or something keeping you sustaining on your own. You've got to kind of have other steps to get up to the next level and then the next level. So you want to start off with syndicating transactions, because then you don't have to have raised all the capital at once into a fund. You can have those investors that you syndicate a part of that off to, and family offices. Now they're interested if it's a family office, but you have to be geared up to sell to family offices as opposed to individuals. So there's different channels for all that stuff, but we've kind of been through them all and had to learn, because we used individuals and no family offices to syndicate transactions. And we quickly learned that not everybody knows Rob Sechrist. When I sell a deal on our platform, it's gone in like no more than 30 minutes. But when we were going to family offices, it was going to a whole nother department that nobody knew me. And that deal had to sell itself on its own on the piece of paper. And that we had never written a credit memo, because we just didn't ever need to. We'd have a 2-page summary of just literally what is the yield, because they knew us. But when you get to the next level of family offices or institutions, you need to move to credit memos. Well, okay, well, how was that credit memo put together? What's the credit policy? Oh shit, well, we got to develop a credit policy. It's in my head. So then you got to go build that credit policy. And well, who do you want to be doing that credit policy? Are you an expert at writing credit policies? You're probably an expert at underwriting, but have you ever written a credit policy? No, then I don't want to spend my time. So we went, and for everything that we did, our motto is always go out and hire the very, very best we can possibly afford. So we've been lucky to go to the top top of every single element. We used Sechrist Asset Management Company, the #1 underwriter in the world. They've done $7 trillion of underwriting for Goldman Sachs, Oaktree, BlackRock. And in fact, BlackRock even owns part of Sechrist, and they had already seen and knew about us through that relationship. And so all these things are just evolutions, but you don't want to just start off by launching a fund that has no assets and pay, $75,000 for a credit memo policy that takes 6 months to develop, and you have to have the experience. They don't write it for you. You have to, it's a interview process, an amalgamation of what their best practices are and what your best practices are to pull those things together. And when it's cannabis, it was really way out there. And to get Sechrist Asset Management to take on a company like us that's very small, we only could do it by selling the story in our personalities. And they're like, you guys, this is so awesome. We want to do it. We're gonna do it with you guys, and we're excited to do it because we kind of need to know more about it, and you guys are the leader in the space. So we've used that to our advantage where we could. We've tried to third party off everything that we could with the top and best people that we can. Armanino was our auditor, which then we grew too big and needed to have a fund administrator. So they became our fund administrator, and we needed even bigger brand name for our audit. So we went to Cohen Resnick, because that is a name that institutions know. Institutions probably don't know of Armanino, but they do most of the hard money funds audits. So all these things are just a process, and which fund structures do you want to use, and what's going to be the fit for you and why, and what do you do for if you've got an international investor that wants to come in, and what do you do if, what strategic relationships are worth your time? So our biggest investor is $25 million commitment. And I utilized that strategy of, going after cannabis equity investors. So I targeted all the cannabis equity, the biggest funds out there: Merida, Gotham Green, Kronos, some of the smaller ones too, Poseidon. And I said, hey, why don't you look, I'm going to make this so easy for you. You have something on your balance sheet that doesn't show up as money. You've got all these LPs, you've got their money, but that relationship is more than just their money. Why don't you send a simple email to them and say, do you want to diversify your allocation from all equity into some debt? And I told all these guys, I said, why don't you create a feeder fund that is your investors, they come into your own fund, and it's just a feeder fund into ours. It's no skin, you have no day-to-day management of anything. You underwrite and see what everything that we've done on this side, we pump everything through to you as an LP, you push it all out to your LPs, and you can take your whatever spread you want. And some people don't like it because it was potentially diluting their money from their investors, they thought, but in reality, it's not, because it's debt, and equity is typically, you want to have a specific ratio of debt to equity in any asset class. But one of them said, that's brilliant. Let me just see if there's any appetite, because you don't have to go create the fund. You don't have to do anything. You just send an email. Are you interested? Yes, we wanted this. Or no, that's not. One of them had so many responses. They created a feeder fund to us, and that's our largest investor, and it's a $25 million commitment.